Hi, my name is Mike Cannizzaro. I'm a senior strategist with E-Trade Securities, and I'm here today with Morningstar's Jason Kephart and Cannizzaro. These are two of Morningstar's alternative strategies analysts. Thanks, guys, for joining us today.
Thanks for having us.
Thanks, Mike.
All right. So there are quite a few people out there that realize that they need more growth from their investing than what they can get from just basic savings. But for a new investor, they may be somewhat intimidated by some of the complexities of the market or from buying securities. How would you advise someone who is perhaps dipping their toe into the investing stream for the first time, so to speak?
I think the first thing you want to do is identify your goal. Are you trying to save for retirement? Are you trying to save to send your kids to college? Are you just trying to look for some extra spending cash down the road? And that will help you figure out what your time horizon is, which will help you figure out your risk tolerance, and from there you kind of build a portfolio.
And secondly, I think investors should stick to the basics. There's simple stock funds, simple bond funds, and those are the building blocks of an essential starter portfolio. And you shouldn't get too fancy and go for the hottest asset class or the most complex products.
Okay, great point. So you mentioned using funds as a good way to get started. How can someone understand, a little bit more about the basics of a fund and how it manages towards a specific objective? Do you want to take that one, AJ?
Sure. Most funds manage towards a benchmark, and the main ones to know about here are the S&P 500 for stocks and the Barclays aggregate for bonds. And these can be thought of as representative of the average return of someone invested in the stock market or the average return of someone invested in the bond market. So an active manager is going to attempt to give you returns above that if they're successful, or at least give you something that looks a lot like that index return.
Okay.
There are also index funds that people can use to just get the market return, and these are typically much lower cost. They're probably a little easier for people to wrap their arms around. You don't have to worry about picking the right manager. You're basically just picking the marketplace that you want to invest in.
So that's a good point. We talk about, picking funds. What are some of the criteria that a person should be looking for in trying to select funds that have a good track record?
First and foremost, you don't want to over-rely on recent performance. It's very easy to get sucked into whichever fund's been doing the best lately and end up buying at the top and selling when it's not doing so well. You really want to understand why a manager's doing well. Some things you can look at are manager tenure, look at certain periods like 2008 or summer of 2011, see how the fund did then, and you also want to pay a lot of attention to costs.
Should a new investor, before they even think about investing, be looking at their overall portfolio construct first and then determining, which way to go?
Absolutely. You want to be properly diversified, and that could be anything from owning a mix of stocks and bonds to just owning a mix of stocks with different risk characteristics like large caps and small caps.
And then as for determining what that asset mix should be, it depends on the time horizon of an investor. If they're saving for retirement, the time horizon is going to be usually much longer. So that's going to result in a mix of more stocks and less bonds because you can afford to wait out those stock market recessions.
Great. And then one final question. How often should someone be revisiting their portfolio strategy? Perhaps they started out as an aggressive investor, but they're not certain as to at what point they should be taking risk off the table or thinking about changing their overall allocation.
As you get closer to whatever goal you have in mind, be it retirement or sending kids to college or buying another house, as you get closer, you probably want to get a little bit more conservative. Also, any life events that happen that might make you change and revisit your strategic allocation. If there is a birth in the, you have another kid, maybe that's going to change how aggressive you want to be with your own retirement savings.
Mm-hmm. These are the questions that a financial advisor, for example, would be tackling. But it's really not a science. It's more of an art to determining your glide path towards that end goal. How should you change as you get closer?
All right, great. Well, Jason, AJ, thanks so much. I think you've given our new investors some really good guidance today. We appreciate your time.
Thank you.
Thanks.